Thanks for joining. I think there are still a few attendees who are joining as we speak. I thought we'd get started. It's now 11 o'clock. Just to start, just to make sure that anyone can hear. I assume everyone can hear me, but if you can't and I'm coming across blank, can you just maybe say something in the chat? Otherwise, I'll assume that we're good to go. Okay, great. Well, thanks all for joining. Thanks, James, for joining too. My name's James Kearns. I'm head of the legal team here at Dragon Argent. Dragon Argent is a multidisciplinary professional services firm. We offer accountancy, legal and advisory services, generally for tech-enabled startups and SMEs who are on the journey of seeking investment, and usually on a sort of a 5-year exit plan to see their rewards at the end of that journey. I'm joined by James Church, and I can hand over to James so he can introduce himself, and he's from Mascot.
Yeah, thank you. Yeah, thrilled to be here. Thanks for putting this on and having me. So yeah, I'm James Church. I'm the author of the best-selling book, got a copy here, Investable Entrepreneur. I'm also the co-founder of a company called Mascot. We're basically an investment readiness agency. So we do all of the hard work, making sure that you get prepared adequately for investment. We do business plans, financial forecasts, pitch materials, valuation reports, all the things you need to adequately go and raise investment. And we also have a whole investor outreach service as well, so we can reach thousands of investors on your behalf and get them interested in your round. And when we primarily focus on pre-seed, seed and Series A funding, that's our sweet spot. So that early stage funding, often our founders have kind of never done this before. It's their first go at raising funding, and they're looking for that expertise, those insights, that support, and that capacity to make sure they do this right, and they give themselves the highest chance of securing the investment that they need. And very, very quickly, just say, look, when we work with clients, when we take them through our process, they're 40 times more likely to raise investment. They've raised more than 220 million today. We know our processes work. It delivers results weekly for our clients, and yeah, that's what we do.
Brilliant. Thanks, James. So just to sum up in terms of what we're hoping to achieve through this webinar, in summary, we really just want to give founders a better understanding of the investment process. We want founders to be able to be better prepared and to really understand what to expect in the whole process, and then I suppose what they should be doing now to help to prepare themselves best to take on investment. The plan is we'll speak for half an hour or so, just going through a few key topics, and then we'll open it up for questions. But if you have any questions as the webinar proceeds, just pop them into the chat, and then we'll get to them at the end of our session. Okay, great. Thanks again, James. So we've got a few major topics in terms of the investment process. On the schedule that we sent out, we actually started with due diligence, which is a key part of this whole process. It's not necessarily the first part of the process, but it's something which we put first, I think, because it's something that founders should be thinking about now and being prepared for now. So James, just to start with you, I mean, what are investors looking for, and what should founders prepare for in those early stages? What should they expect in terms of investor due diligence?
Yeah, I think very few founders think about this part of the process. I think most first-time founders raising investment for the first time, they kind of see what's on TV. They see kind of what happens on Dragon's Den, and it's a sexy, exciting pitch. There's a bit of back and forth with the investor, and then they say, yeah, I'm going to invest, and there's this stack of money on the table, and the assumption is you sort of walk out filling your bag up with that money and just walk out the room off into the sunset. And the reality is that there's a whole load of due diligence that happens off camera. 80% or something, 50% of the deals that you see in the den never actually go through because they fail the due diligence. And this could be around the legal structuring of the company, issues with the co-founding agreements, the shareholding agreements, all kinds of things. And you'd be able to talk on this much more, but I think it's really vital to make sure that you understand that full process, that it ends in this due diligence phase. There's going to be a lot of scrutiny over that, and it doesn't matter how good your idea is, how good your pitch is, how great your business case is. If you're not adequately prepared for that due diligence, that the money's not going to land in your account and the deal's going to fall through. So I guess what I'd love to understand from you, James, is kind of what founders would expect. Kind of, you know, you get to that end point, you've got an investor saying, yes, I'm keen, I want to invest, but I've got some checks I need to do first. What are they checking? What are the main things, and where are the biggest downfalls from what you see?
Yeah, absolutely. So I say we are fast forwarding slightly. We've probably got to a point now where those initial conversations with investors have taken place. The investor is keen and perhaps presented a term sheet, something we'll come on to a bit later. But then the next stage will be really sort of kicking the tires and looking under the bonnet of the company. And what that will usually mean is that the investors will instruct their own legal counsel and solicitors to prepare questionnaires, one of which is the legal due diligence questionnaire. And that can be quite an extensive document, can be quite daunting to look at, but it covers off various topics, various subject areas that asking the founders to answer questions about the state of the company. And the reason behind this is, if you're putting £1 million, £2 million into a company, what is it you're really investing in? You're investing in something you think has a particular value. And the legal due diligence process, as well as a financial due diligence, but one of the key points about legal due diligence is trying to establish whether that value is actually there or not, or the potential value. So, for example, if a lot of our clients are sort of tech-enabled, sort of B2B companies, and their principal asset really is the IP and the tech platform that they've created. Now, it sounds quite simple, but if I'm an investor into a company, I want to know that that company owns that tech. I mean, it may seem like a bit of a no-brainer and you should expect it, but it's quite common for founders in that kind of world. They might be working for a tech company, and you know, in the evenings and weekends, they've been developing on the side a piece of tech that they then want to quit their job and make their millions developing. And the question is, well, does the actual company own the IP to that tech, or does the individual own the IP to that tech? And potentially even worse than that, if the individual was working on company time, if they were working for Amazon or Google, could Amazon or Google own that tech in the worst case scenario? So it's very simple, fundamental questions like that the investors are trying to get at. You know, what are the assets? Does the company own the assets? Are there any risks to those assets? Another thing could be, for example, I mean, you touched on it there about co-founding agreements and share structure and things like that. It's very common for founders in early stages to take people on and give them sort of vague promises. I'll give you 5%. I can't really pay you right now, so we'll give you 5%. It's never written up. What does it mean to say they'll get 5%? 5% of what and at what stage? And again, the legal due diligence will come in and really get to the bottom of those questions and understand what it is that they really mean. But again, it covers a wide range of issues. The questionnaire could be your premises, any environmental issues, all sorts, just anything which potentially could present a risk to the asset that they're investing in.
Is there anything that the founders sort of on this call should be thinking about, sort of pulling together and thinking through seriously kind of at this stage, like before they've even thought about going out and pitching, to prepare themselves for that and make sure they're not kind of backtracking, or they're not suddenly presented with this questionnaire and thinking, crap, where do I find this information? Do I even have it anywhere? What are the sort of fundamentals that you should be doing at the very earliest stages, ready for when that happens?
Absolutely. Yeah. Well, so, I mean, I say in a general sense, good housekeeping is good for these kinds of things. Keeping all records, making sure HMRC filings are all up to date, companies' house filings are up to date. Make yourself essentially a presentable business. That doesn't just save you hassle, but it presents you in the best possible light for any investors looking at you. It shows that you're organized in the background. Again, things like, if you have employees, do you have employment contracts for them? Again, a lot of founders in early stages do things on a very informal basis. And what will happen is certainly when a VC comes in to invest, they're going to insist upon a lot more formality. So it's good to get those things in place earlier rather than later.
I guess Check your employment contract. If this is your side hustle, check that your employers don't own what you're
Precisely. Yeah. And that's another good point, which is they're going to be saying, well, yes, sorry.
Check supplier contracts, perhaps, like if you're using a third-party developer or a freelance developer, they're
Well,
probably
absolutely, yes. Yeah.
the freelance developer, but you want to have an IP assignment or something. I don't know what it's called, but there'll be some kind of IP assignment agreement that absolutely nails in black and white that anything they create for you is yours, and not theirs. And the same with any agency you're working with as well, right?
That's right. Yeah. Again, it goes back to that point. If you're developing it yourself, who owns that IP? If you've subcontracted that tech development elsewhere, they're going to want to see that contract, and they're going to want to make sure that all IP vests to the company. So again, it will depend on the nature of the business. I'm using tech as an example here, but it could be anything. Think what your key asset is and how safe that asset is, and that includes individuals. That includes employees. How committed are they to the business? So that's one thing. Obviously, there's the financials as well, something which I'm less well versed in as a solicitor. But again, there'll be a similar process where it could be the accountant to the investor, or the lawyers would submit a series of questions or want to see various financial information. And again, the point about that is looking at whatever financials the company has reported, making sure they're an accurate representation of the state of the company, and also trying to find whether there are any undisclosed liabilities, because again, if all of a sudden you find out that there's a big liability against the company, it drastically reduces the value of the asset you're investing in. So that's the general idea around due diligence.
Yeah, fantastic. Yeah, good bookkeeping, good kind of organization. Probably setting aside kind of a Google Drive or a Dropbox folder where you kind of think, if I've said to someone they're going to get 5% equity, let's find a template. Let's use a platform. Let's use someone like Dragon Argent to just draft up a quick kind of heads of terms on that, as to when it's going to happen, how much equity, get the key terms down. Nothing needs to happen until we raise, and we can issue the shares then. But let's get that kind of in black and white, from a verbal to a written agreement between the two parties, and at least have that in a kind of a Google Drive somewhere, so you've got all of these things in place, right?
Yeah, absolutely. I mean, I think in that specific example, and maybe it's just the lawyer and me saying this, obviously I want to see a kind of formalized agreement regarding any options or share allocation, purely because there were tax connotations of doing that as well. But you're absolutely right. I think the key point here is that if there is a Google Drive where you can just file everything, keep everything in order, keep up to date with HMRC, register with all the relevant bodies that you might need to register with, depending on the nature of your business. That's the way forward on this.
I mean, it sounds really boring, doesn't it? We're talking about folders and organizing kind of folder structures of legal documents, which for many founders is just like, oh God, but it's the thing that's gonna really like hinder you in closing that round at the final. You're going to do all of this work and you're going to get so excited. You're going to have investors really wanting to get involved in your vision, and then it's all going to fall through because you haven't done the kind of basics and the kind of the boring stuff, I suppose, of kind of getting all of these documents in place and in the right way and available for these investors to see. And you're going to be scrambling around trying to get it all together, and they're going to, in the meantime, they go and find someone else to invest into, and suddenly that capital's not on that cash isn't on the table anymore.
Absolutely. And I've seen examples where exactly this has happened, where and you might have some insight on this as well, when companies are timing a particular round. Obviously, early stage companies have a certain amount of runway of cash to get to that investment, and they might time their fundraise around that runway. If you get to a point where you have engaged with the VC, signed a term sheet, started to negotiate documents, and in the meantime, you're getting to the end of that runway, and all of a sudden, you now have to run around for 2 weeks sorting out things that could have easily been done months ago. It just puts you into a real bind, a bit of a squeeze. So I think it's certainly not something you want to be worrying about at the sharp end of deal closure.
That's it. Awesome.
Great. So actually, I mentioned briefly on the financials in terms of purely the accounts that the investors will want to look at. But if we rewind slightly now, before an investor has even been found, founders are trying to put together a bit of a proposal, a bit of a pitch deck, a bit of a forecast as to where their company is going. Financial forecasting is a key part of this. Would you be able to sort of explain what we mean by that, and perhaps talk about how founders should best approach putting together a financial forecast?
Yeah, so I like to start this question with a distinction between, and I don't know if this is an official distinction, this is my distinction, between a financial forecast and a financial projection. I think they're two different things, and they you can think about them in a different way. Because if you are an early stage founder, pre-seed, seed, series A, you probably don't have much historical financials to go on. A lot of it's guesswork. A lot of it's best guesses based on previous experiences, based on third-party research, based on your own understanding of the market and the product and the research you've done. For me, that's projections and not forecasting. Forecasting is growth based on historic data, and that's much easier to achieve kind of a realistic and believable assumption. If you've got 5 years worth of trading data and you've grown 20% year on year, and you know exactly what your cost per acquisition is, and it's just a case of put more money into the top of the funnel and we'll sell more at the bottom of the funnel, that's an easy forecast to create. We've got historic evidence of 20% year on year growth. If we want to continue that trend, we know we need to put an extra X amount of capital into the sales funnel, and we're going to need additional resources in operations in these areas. Pretty simple to do. Projections, on the other hand, are where founders get stuck, because that's what most founders are doing, is they're projecting into the future, an unknown that is unknown to you and unknown to investors. And the key thing to think about when you're producing these projections is that you know they're made up as much as the investor knows they're made up. And the point isn't to get an accurate forecast, it's to set a projection. If all goes to plan based on the business case and the business model and the business plan we've put in place, if everything goes to plan in the short and the long term, this is where the company could end up if all goes well. We know there's going to be twists and turns along the way. There's going to be pivots. There's going to be changes of direction, and this is going to be completely different in 5 years' time than where we are to what we think is going to happen today. But the point of this exercise, because you might then think, well, what's the point? What's the point of this exercise? It's hard enough for me to know what's going to happen in the next 6 to 12 months with my business, let alone the next 5 years. So what's the point of this exercise? If it's a projection that investors know is made up, why are we bothering with this? And why are we doing this silly dance around the numbers? And what it's there for is to show your strategic thinking, help investors understand the way you think and the potential you see in the business. And do you currently think that with my investment, you're going to reach profitability in 6 months and you're going to be a unicorn by Christmas? Or do you think, do you realize that there's a long-term plan here, that you're going to be losing money for a considerable amount of time until you hit that kind of break-even point and you kind of really manage to figure out your go-to-market strategy, and then you've got a repeatable sales funnel that can rapidly scale the business from here to there, and that's where we get that hockey stick from. And do your expectations align with the reality of how startups are generally built? Have you kind of understood how businesses like yours progress? Do you understand that, by the time we get to the end of the projection and we're in a position where we're hopefully showing at the end of the projection we're in some kind of exitable position, like we could exit the business at this point, we could continue on a further 5 years of growth and 10x the business again, but we've grown it sufficiently enough to achieve an exit if we want to. Do we understand how much money should be spent on marketing for a business of my type in my sector? What's a best in class kind of marketing budget for this type of business? What kind of profitability should we have? What do our margins look like? How much revenue should we be generating for every member of staff we employ based on kind of industry expectations for our sector and our product? What kind of, are all of these metrics and ratios, our headcount, do all of these things kind of align with a business that is generating, I don't know, let's say 50 million revenue and 10 million profit in a consultancy industry or a restaurant or a tech company? Do these things all align with what best in class kind of metrics look like based on historic performance of those types of businesses. And then what you're saying is, I have this financial vision. That's what the projection is. It's a financial vision for the future. It's not a prediction of the future. No one's expecting you to have a crystal ball. It's a financial vision. And what you're really saying is, look, I've really thought this through. I know the stepping stones I need to take, and we want to get to this position, because if we get to this position, we've got a highly profitable, highly exitable business. People are going to be queuing up to want to buy it because all the metrics and ratios and everything align with what makes an acquirable business. That's my goal. There may be a different path to getting there. There'll be bumps in the road. There'll be different directions to take. But my goal is to get to this point. And therefore, you can trust me with your investment, because whichever path we take, it's my mission to end up there. That's my strategic aim, is to create a business in this financial position so we can all walk away with the best possible return. So you need to start thinking like that with your forecasts and going, this is my strategic vision. This is where we want to get to. This is where we need to be to deliver investors a return. And for us to walk away happy with the return we're getting on our own personal exit, we need to get it here. And we're showing the financial path to doing that and the funding required to make it happen based on your understanding today. So it's not
sorry, yeah. So it sounds as though from what you're saying then, that actually potentially a huge amount of research needs to go into the industry that you're in order to create something which is credible to an investor. Because if you are projecting, and it's ultimately guesswork, as you say, but you're kind of relying on historical information from the industry that you're in. So is that a takeaway today, that founders should just be completely steeped in that industry?
Yeah, you should know your industry inside out. You should know what equates to good performance, right? So if you're a SaaS company and you look at kind of you should be able to figure this out by looking at the P&L of high scale companies that are publicly listed, that you can see the forecast of, but you'd be able to work out the ratio of what the marketing spend was. So they may be generating 500 million in revenue, but how much were they spending on marketing? What does their headcount look like? You go find them on LinkedIn. You'll get an idea of what their headcount looks like, and you'll go, if I want to get to 500 million, I need a similar headcount. Because think of it this way: if you're going to get best in class margins, so you're looking at this company and they're getting 30-40% EBITDA margins, and you're going, so therefore we should be able to achieve the same. If you're doing that at a smaller headcount, then there's a red flag for me as an investor, unless you have been very clear on how your product, your innovation has enabled you to create a system that can do the same amount of revenue and deliver the same kind of volumes of sales with half the number of people involved in the business. You better be able to convince me that you've got some incredible operational tool or system or structure that your product, your technology that you're building facilitates, that allows you to do it twice as profitably as the industry leading incumbent. Because otherwise it just all falls down. You don't look credible. It's like, how could you possibly believe you can do it? These are a best in class in your industry. You've got to convince me you're getting better numbers than them, or you need to match it, right?
And so, so what you said then, you can almost put your words into the mouth of an investor at a pitch, potentially. I mean, these are the kinds of questions that founders will get when they go to pitch to VCs.
If you're building, let's say you're building a restaurant chain, it would be ludicrous to go and go read some blogs about raising investment and that say investors are looking for a 30% EBITDA margin. Restaurants don't get 30% EBITDA margin. They get 5-10% EBITDA margins if they're lucky. And they can probably only afford to spend about 10% of their revenue on marketing to achieve that, because of the costs of operations and the costs of the actual product they have to develop. Whereas a tech company, 30-40% EBITDA margins is expected. But because there's very little operational cost, because it's delivered by tech, you also would expect maybe 20-30% of revenue to be spent on marketing if you're looking for hockey stick style growth. Whereas a consultancy might only spend 5%, 10% of their revenue on marketing, because they've got loads of staff to pay for to deliver the service that they're offering to customers. You really have to understand your sector and your business model and your technology and your niche to figure out what these budgets should be and how. And obviously, like, all of these things are going to be completely out of kilter in the first couple of years. 200% of your revenue is going to be spent on staff, and 300% of your revenue is going to be spent on marketing. Obviously there's not enough money to go around. That's why I'm raising funding. But as we move towards year 5, we should be able to see the transition of 200% of revenue being spent on staff to maybe 10 or 20% or whatever your industry kind of average is, so that you can show that you understand where you need to get to make an acquirable company. And
so go back to
now.
So to go back to the theme, which is of what people can be doing now. I mean, I come across a fair number of sort of founders who, I suppose, they might have developed a neat bit of tech. They're a very talented software developer, or they've had an idea and they want to make a start with that. And then, in terms of everything you just said there, in terms of margins, in terms of industry knowledge, they might find all that quite daunting. Where would someone like that start, who feels that they got a great idea, a potentially game-changing piece of kit, but they want to do everything you just described there? Where should they start?
I mean, Google is your best friend, right? There's a load of resources out there on Google. Create a list of kind of businesses in a similar sector to yours that are that would be market leading, and you might be able to find and download through Companies House or somewhere else their kind of financial data, their P&L forecasts. If they're sizable, that should be fairly publicly available. Have a think about businesses with similar technologies in a different niche. So they're still an enterprise SaaS technology platform, for example, or they're using a similar technology or a similar product. So it could be you're building a new consultancy, and you could look at one of the big 4 consultancies like KPMG, but you're building a marketing consultancy. But at least you can see kind of what scale looks like, and just start getting an understanding of what their businesses look like, what their staff costs are, how much they spend on marketing, and just start researching those things, and just turn to Google to see if you can find industry expectations around how much marketing should a consultancy spend to grow their business, or just start asking those questions into Google and finding credible sources that will give you a bit of a guide. No one's expecting perfection at this early stage. You learn these things as you go, and you're always striving for better and better profitability as a business owner, while not sacrificing the quality of the deliverable to the customer. But you need to have a starting point understanding of what good looks like and what best in class looks like in your sector or in your niche, because otherwise you really are just making it up. At least if an investor says, well, how have you got to these numbers? Like, these just look, you've just made these up. You can say, well, at least, I've looked and cross-referenced this with this company, and they all achieve average revenue per staff of X, or they spend Y on marketing, and they've been growing at a 20% growth rate for the last 3 years. We've used that to inform our model and our assumptions and our thinking. So at least the investor goes, well, at least you've thought about it. At least you understand kind of what this hypothetical future looks like, and it's based on some kind of logic and some kind of reasoning.
Actually, on that point, and we're going slightly out of order again on this, I wonder it's a good time to move on to the concept of valuation. We're skipping around a bit, but this idea of you're just making it up, I think that plays in the minds of a lot of founders when it comes to valuation. When they've put together maybe a small team, they might not be put a team together at all. A couple of people with an idea, with a bit of development, but certainly no revenue generation at this point, or certainly no profit. And then they're in a situation where they're trying to attract an investment, and they're having to put a number on their company and say that the company is worth X amount, and it can often be in the millions. And it seems quite an odd experience for certain founders to say their company's worth 5 million when they've been going for 2 months and they've just got an idea. How would you help, or how do you think founders should approach the concept of valuation when going into an investment?
So I think you should use lots of different approaches and come up with an informed conclusion. So rather than the classic, I need to raise £1 million and I don't want to sell more than 15% of the company, and therefore my valuation has to be this. Because those three things are, of course, intrinsically linked. The amount you're raising, the amount of equity you're selling, and your valuation are intrinsically linked by mathematics. So the amount of founders I see where those things don't add up, but so make sure those things all add up. But so rather than just going with that approach, which is obviously the a kind of self-serving approach, but gives you no credibility when they say, well, how can you justify that valuation? You go, because I don't want to give you more than 15% of my company. That's not a good reason. So let's look at different methods. So you could use discounted cash flow methods. There's a few different versions of them. They're quite popular amongst founders, and they're great because they look at discounting the future value of the company, the future cash flows in the company back to today by discounting it via risk rate and failure rates and things like that. And you can use a discounted cash flow model. However, they have limitations. And again, they're more accurate in these forecasting rather than projection scenarios that I talk about. When you've got 5 years of historic data on your forecast and you're creating a forecast, they become really quite reliable because you're pretty certain you can grow at that rate. But most early stage founders using kind of their 5-year projections to do a discounted cash flow valuation are just going to end up way too a higher valuation for the market. But you can do the exercise and you can kind of go, this is what the valuation would be. You could then look at just purely looking at it from an investor's perspective and going, right, investors that I'm speaking to angel investors, they're looking for typically a 10 to 30 times return on their investment. So if we were to look at our forecasts and kind of figure out what our exit valuation might be by looking at some industry exit multiples and multiplying that by our forecasted revenues or our forecasted profit, what would our exit valuation look like? And if they're looking for a 50 times return on investment, then what would they need to invest in us today for them to achieve that if we were to hit our plan? And then maybe we'll discount that by a further X% just to account for the risk involved of whether or not that actually comes true. And then we've got a sensible valuation from an investor's perspective that we can say, well, if you invest in us today, you're going to get the return you're looking for in the future. And we've discounted it further to account for the fact that their projections based on quite a lot of risk and a lot of assumption right now. You could do some scorecard and checklist methods, which look to score you in different areas of the business, like the strength of your team, the size of the market, the uniqueness of your IP, and you could kind of score out of 100 how you feel you perform versus your peers in each of those categories and assign a value to each one. And you can Google all of these different types of valuation methods, but you could use them all, do all of these different valuation exercises, and then come up with a weighted average and kind of go, well, the scorecard and checklist methods, they're really well suited to early stage companies. The discounted cash flow, as we discussed, is more suited to later stage companies. So maybe we'll do a weighted average and we'll kind of average this out, but we use 30% of the valuation on these two early stage valuation methods, and we'll use sort of 10% of the valuation on these two discounted cash flow methods, and the rest will make up the VC method, and we'll do kind of this weighted average and go, this is our valuation. And then you can go to when the investor asks that question, you can go, here's all the calculations, here's the different work we've done, and here's where we think we lie. Then you can cross-reference that further with the idea that most investors want to make sure they have at least 15 to 20% stake in a round. So you should be willing to at least sell that, if not a bit more. And then you can cross-reference it further with actual activity that's happening in the market. What deals are being done right now that are similar to yours in a similar stage of development, and what valuations were they able to achieve if you can contact the founders and find that out, or maybe you can find it out on Crunchbase. But you can kind of get a sense of what their valuations might be. And when you're doing that research, just a caveat, look at what deals have been happening in 2023. Ignore 2022, 2021, and 2020, because they were crazy years where valuations were just ludicrously insane. And look at 2018 and 2019 deals. You're much better off comparing yourself to deals that were happening in 2018, 2019 than you were comparing yourself to deals that happened in 2021 and 2022, because that will be more realistic as to where valuations are at today in the current market. So yeah, lots of ways you can approach kind of justifying your valuation, and kind of really doing some work around it and thinking it through.
But again, I suppose to wrap it up, and it's a common theme with what you've said about financial forecasting and projections. I think it seems to me as though it's all about having an answer. If someone were to question these things or to ask how you arrived at a certain figure, you'll have credibility going into that conversation if you can talk about all of those metrics that you've pulled and as long as it's a defensible position, then it gives you credibility in the room.
And you hit the nail on the head there with the word credibility. That's what investors are looking for. They're looking for credible founders that they can trust with their cash. They're not looking for great ideas. Everyone can have a great idea. They're looking for credible founders they can trust with their capital to deliver on an implementation strategy that's going to bring that idea to life and turn it into this exitable business that we said about. That's what they're looking for. And so you can bang on about your great idea as much as you like till you're blue in the face. It's not going to win you the investment. The people, the 1 or 2% of people who are closing deals right now are the founders that are able to show that they're a credible pair of hands, that they're a safe pair of hands, that they can be trusted with their capital. So the more you can do on justifying all of these things, and not just going, it's a brilliant idea, it must be worth millions, and actually sitting down and doing some work behind it so you can hold up to investor scrutiny, that's the marginal gains you need to turn from an investor discussion into an investor writing a check and depositing it in your bank account.
So that leads quite nicely then on to, I'll ask a question, what makes for a credible pitch deck?
Yeah, I mean, two things. As I said, showcasing a brilliant and exciting idea in a large and scalable market that has huge potential and huge opportunity, but also that you're a credible founder that has a strategic plan on how to deliver success. So you need to cover those two things. You need to cover the vision and the value proposition. You need to back up that that's something that the market wants and needs through evidence and research. And then you need to outline a strategic plan that's going to deliver short and long-term growth. And then you need to outline the financial impact of that plan and how much investment you need to execute it. And if you can do those 5 things really quickly in a pitch deck, you're going to speak to the head and the heart. You're going to engage the heart in the vision and the value proposition and go, this is awesome, I love it, this is such a great, I can't believe no one's done this before, this is so needed. And you're going to get that emotional reaction. And then on the second half of the plan, we're talking about the strategic plan and the financial performance and the evidence you have to back this up. This is all talking to the head. It's that logical connection to the investor to go, yes, these founders or this founder understands how to play the game. They know what it takes. And I feel comfortable, and this is the main point, I feel comfortable investing my time in finding out more about this. Because the pitch deck's just the summary. It's the top level overview that gives the investor the confidence to invest their time, not their money, but their time in finding out more about whether or not they want to invest their money. But the pitch deck isn't the thing that's going to close the round. It's the thing that opens up further conversations. So you should always go into it. You're pitching for the investor's time. It's a top level summary that covers those 5 points. And if I can get that across in a few slides, I'm going to open conversations, and then we're going to go through this whole process, looking at the financials, going through the due diligence, and then closing the deal. But yeah, that's for me what would make a great pitch deck. Is that similar from your experience in terms of the founders you've seen that have been successful? They've got that clear and articulate kind of conversation starter.
Absolutely, yeah. I think it's investors obviously will see a lot of pitch decks across their desk, and they don't want to waste their time. So it seems to me as though you need brevity, but you also need to present the proposition as comprehensively as possible without boring the investor, getting the point straight across to them. And I think that's the key point. I mean, I think that's where I've seen founders go wrong, is perhaps they just throw too much information at investors and expect the investors to do the work. And I think they need to take them on a bit more of a journey and lead their thinking somewhat.
I came up with a little phrase this morning accidentally in a support session I was giving one of our cohorts on our pitch ready sprint. And if I can remember it rightly, I felt I should have jotted it down at the time, but founders think that the pitch deck should provide all the answers, but it's not. The pitch deck is the prompts, so the investors ask the right questions. So prompting.
Sorry, actually, we just had a question pop up on the chat saying how important is the Q&A session that follows the pitch, which it seems as though it's vital.
I mean, Your pitch should lead them to ask the questions that you're wanting to discuss and talk about, right? The whole idea of the pitch is for them to go, this sounds exciting, I want to invest my time in finding out more. So it's about making them ask questions and leaving enough there. I say it doesn't provide all the answers, it's the prompts for the questions, and they want to go, great product, I'd love to know more about how that works and the technology you've got behind it, because they might be tech focused as a VC or an angel, or they might be from a marketing background. They might not care less, so they might be a complete technophobe. They would much rather focus on the market potential, market opportunity, and your go-to-market strategy. So it allows them to then zoom in, and it prompts them to ask questions around that. And they go, oh, interesting go-to-market plan. You said something about partnerships with industry-leading suppliers. Like, do you have those partnerships in place? Who are those partnerships with? I'd love for you to explain more about these partnerships you're going to use as part of your go-to-market strategy. And then you can talk about it. So it's about prompting the questions out of the investor that you want to talk about, because you've done something really incredible in that area, rather than listing all of these partners and this whole strategy out on a slide in tiny little writing that no one can engage with. You're prompting those questions.
Right. And so, subject to a successful pitch, there'll come a point, hopefully, for founders where they're presented with a term sheet by a VC or an investor. Obviously, as a solicitor on the side of companies and investors, I've got a few thoughts on approach to negotiations. But any thoughts from you, James, on what a founder can expect, or presumably, if they've done everything you've said, if they've done this right, they can approach into negotiations with quite a lot of confidence.
One would hope, right? And then that's the position you want to be in, is to give yourself as much leverage as you can, and give you, the more credible you are, the easier the negotiations are going to be, because you've built that trust, you've built that foundation. I think from my perspective, you'll be able to talk about this much more than I can, but from my perspective, this is about setting up the opportunity to negotiate. So everything you do should be within the realms of what feels achievable, realistic, and think of this as a partnership with the investor. So the valuation you propose, the equity you're giving them, like think about the investor and kind of their perspective. And if it feels like it's a good deal, maybe they're getting themselves what they feel is a really good deal, the negotiations are going to go much easier. This is about building a relationship with an investor that you're on the same side, that you're going to move towards the same goals. They're not just this annoying thing you have to give you some capital, and you'd rather keep them at arm's length, and you want to screw them over at the soonest opportunity by getting the valuation up as high as you possibly can and giving them as little equity as possible and as a little involvement as possible. This is a partnership, certainly in the early stages. And the more you can do the whole pitch, the forecast, the valuation, everything we talked about, with this view of this is a partnership and this needs to be a deal that feels reasonable to both sides, then you've set yourself up for really good negotiations, and then they'll get closed and everyone will walk away happy. But when you go into it trying to screw the investor over and get all their capital and give them as little in return as you possibly can, that's where things start to go awry in negotiations. But you can talk much more, I think, on what that looks like and how that process.
So yeah, I will. There was another quick question just about, and you may have some thoughts on this, about overcoming the initial judgment that founders may get approaching VCs or private offices about the founding team lacking pedigree as a startup, having not raised funding before. Any thoughts on that? I mean, my initial thought would be,
isn't it? Like, it's like if you haven't raised investment before, and the criteria is to invest in founders that have raised investment before, then no one invests in anyone ever eventually. So it's kind of, you're only ever going to invest in serial entrepreneurs who've already exited, because they're the only ones who will have ever raised funding before. So what you really need to be showing is the mistake most founders make when it comes to showing their pedigree and showing their credibility is that they in their team, whether that be advisors or co-founders or just first employees, they're treating that kind of, here's our team, as a CV, and what they should really be doing is focusing on some key results they've had as a that relate to kind of entrepreneurship or delivering sales or delivering growth or innovation or whatever it is that their role in the company is, that supports their role and says that I trust that these individuals can make this happen. Here's the experience they have in this sector. These are the insights they have that no one else has around how this industry works. These are the, you know, these are the results they've achieved in other scenarios, whether that be in entrepreneurship or whether that being a first employee at a growing firm, or whether that be in a corporate role and you launched a new product internally for the team and this is the response it had. But it's something that just shows more kind of entrepreneur, not just I spent 10 years as a whatever in Amazon or in KPMG. It's like, no one cares. Like, what did you do in KPMG that means that you are more likely to succeed at this game of entrepreneurship, at delivering this business plan, than anybody else? Because someone else could come along with exactly the same idea, and you've got to imagine there's two founders with exactly the same idea. You're one of them, and then there's a competitor, there's someone else, and you need to convince the investor why you, out of anyone on the planet, are best positioned to make this a success. So you need to leverage those smaller wins within that role at KPMG, rather than I spent 20 years at KPMG and made my way up to vice president or something. No one gives a shit, right? It's like, what did you do in that time that means that you're more likely to succeed at delivering this business plan?
Right. Yeah, absolutely. So, I mean, again, once you've got that credibility in the room, once you've got that pitch deck through, once you've received the term sheet, I say you've given some early thoughts on how a founder should approach it. I was going to say that I was talking about what now to expect, what someone expects.
You mentioned term sheet once you've got a term sheet, and I think a lot of founders that I speak to kind of hear that once you've got a term sheet, it's like, am I sending the term sheet? Do they send the term sheet? What happens?
Okay.
3 or 4 different investors that want to, do they all send me a term sheet, and then I have to try and figure out one term sheet between all? Like what does that look like in reality?
So in reality, what we're talking about here is a term sheet. All a term sheet is, it's something that the investor would prepare, or the investor's solicitors would prepare, and it is a non-binding set of terms and conditions on the basis of which an investor would invest into the company. So it would say something along the lines of, we're prepared to give you £2 million in return on the basis of a valuation of £5 million. And then it would set out various terms and conditions, which I'll come on to in a minute, but we're talking about the types of share they're going to want to take, whether they want any representation as directors, what rights they have within the contract, essentially setting out the relationship between the investor and the company and the other shareholders. So it's basically bullet points saying, these are the terms upon which we're prepared to invest. Well, we're going to have to negotiate lengthy documents, but these are the basic terms. So that's what a term sheet is. In answer to your question, yes, you could go off to various VCs and investors and receive from them various term sheets. The issue really is that generally that doesn't happen or shouldn't happen on the basis that usually those term sheets would contain an exclusivity clause anyway, where you're only really dealing with that one VC. So you can't, generally it's difficult to sign 3 term sheets at once because they're likely to contradict each other. They're likely to take away rights from one and give rights to the other. And so it's just too much of a mess. What's more common is, okay, I'm trying to raise 2 million. This VC is prepared to put in 1 million, and I still need to find the other 1 million. And what will then happen is that term sheet, you will talk about it in such a way that investor is the quote unquote lead investor, and the understanding being they're going to lead on the negotiations. They're going to be the principal investor here. And then other VCs, potentially other angel investors, i.e. individuals, might come in on the same terms, but essentially kind of piggyback on top of that lead investor. And they're the ones who essentially are in control of the negotiations on the investment side.
And that's why you do terms lead investor and follow-on investor, because the lead investor is the term sheet from, and the follow-on investors are agreeing to that term sheet.
Precisely, and for the follow-on investor, it's quite an easy gig, because they say to themselves, well, this lead investor, they're doing all the due diligence, they're doing all of the work here. I'll trust them to do a proper check of the company. they've negotiated terms themselves that they're happy with. Well, if they're happy, well, I'll come in. Here's my check for 500,000. So a smaller check, but they, and less specific control, but they'll just come in on those same terms.
If you're dealing with angels, would you be sending out the term sheet to the angels, or would you expect the angels to operate in the same way as a VC and have their own term sheets?
In my experience, I mean, angels vary enormously, but if you've got an angel with a significant check, you may well be expecting them to be, again, leading negotiations, potentially preparing a term sheet. But normally you'll have a group of angels, each putting in 50,000, and it, you know, you, for the same reason I mentioned before, you can't have term sheets coming in from all sorts of angels. It's often the case that you either issue a term sheet and say this is the basis of the investment, or you go one step further and you even enter into a shareholders agreement with whoever is current shareholders and just say to angels, join this agreement or don't invest, because in that situation you've got a bit more power. If you've got plenty of interest from various angels, if they're not interested, if they don't want to sign up to your existing terms, then they don't have to. It's, you know, you're happy to give up on their 25,000 that they're prepared to put in. But it varies massively depending on the individual angel and the size of the check, I'd say. Cool. I'm very conscious of time, so I wonder whether I should quickly run through the kinds of things you see in a term sheet. And I'm also aware that there are some questions that have come in. But just briefly on a term sheet, as I said before, what to expect from it. I'm an investor. You'll expect to see the principal terms, X million or however much in return on a certain valuation. But then there'll be things like, and I think it's probably worth talking about because it hits hardest on founders. There'll often be an insistence on a vesting schedule for founders' shares. And I don't know, James, whether this is something that's come up with your clients at all, but I think a lot of founders find that quite daunting. But the idea here is that if you're a founder, you own 40% each. If you're a couple of co-founders, those shares will be put at risk for the first 4 years of this, from the date of the investment. And the idea being, if I'm an investor, put £2 million into a company, and then a week later you as a founder quit and go and lie on the beach somewhere, well, that's left me in a bit of a spot. And I want a mechanism by which I can essentially punish you for that by clawing your shares back. You know, if I've put all this money into an asset, largely believing in you as a founder, and then you walk away, I need to be able to clean up the cap table, take you off it, and be able to rebuild. It's something that comes up, something that founders, I think, generally are aware of, but they're scared of it, and understandably, because they see it as a mechanism by which they can be edged out of the company. But that's the rationale behind it, and it's very standard, certainly in the VC world. Pretty much non-negotiable or largely non-negotiable.
And I guess that goes back to this idea that it's a partnership and we have to be able to see these things from the investor's perspective, because I have known founders to do exactly that with some angels, and those terms weren't there because they were kind of angels and they didn't understand all of this. And he took almost $1 million in funding and achieved nothing other than lots of business trips with his girlfriend all around the world, flying business class, had a whale of a time, had a lovely car as well, but didn't really build much in the way of some technology. And they had no mechanism to get that money back or get the founder out because they didn't have the terms in place to do so.
Absolutely. And again, one thing to look at on that point is, let's forget the VC, forget an investor for a second. Imagine you're just two co-founders, and you could find yourself in the exact same position even without investment. You get through, you know, you're on this journey together, you own the company 50-50 and you're building value, and then your co-founder just quits. Unless you have a mechanism by which you can get the shares off them, you're then in a position where they own 50% of the company and you're working away and increasing the value of those shares for them. So it
goes right back to that due diligence process and making sure you've got all of these boring documents in place to protect you, and investors want to see them, right?
Precisely, absolutely. Another thing, and I'll skip over a few because I'm very conscious of time, but just wanted to talk about another thing which might not necessarily come as a shock to founders because they may know, but another thing which investors will insist upon will be so-called warranties that the individual founders will need to give about the state of the business. And the reason I bring this one up is that it involves an element of potential personal liability as well. The investors will include a big schedule of warranties, essentially statements about the nature of the business, which the investor is asking you to stand behind. And if any of those turn out to be untrue, then they can sue you personally for breach of that warranty. An example I tend to give would be you give a warranty which says the company's not being sued. So if you give that warranty and then the investor completes the investment, finds out 2 weeks later the company's being sued for £1 million, obviously that is quite a damaging thing to the company, reducing the value of the investor's asset, and therefore they may come after you personally for breach of that warranty. Usually the liability is usually capped at an annual salary or a certain amount, but again, when you're getting into these stakes, you just need to bear in mind the founder vesting, meaning your shares are at risk, and the warranties, meaning you're personally at risk in terms of a potential breach of warranty claims. And another good reason that you need to go through a proper due diligence process, disclose everything to the investors so they can't sue you for breach of warranty, because they're put on notice of everything that may be an issue. There are various other things I was going to raise, but I think time's running low. We've had some questions.
Yeah, there's a really good one here from anonymous attendee, which is a great name. They're talking about how they've organically grown their business through referrals. So they don't really, I was talking about the financials and understanding your customer acquisition costs and all those things. They don't really have data around that to put into their forecasts and kind of use to convince investors. So if they're looking to seek investment to scale, how do we start to estimate those returns? So if you're currently in a business that is grown organically and is profitable, then you're very much in the position where you're doing founder-led sales, probably. These are based on referrals. They're probably coming into you and you're on founder-led sales. The next step for you is to prove what I call go-to-market fit, which is I have a repeatable or showing the beginnings of a repeatable and scalable solution that takes me away from kind of founder-led sales to more of a system, sales and marketing system that generates leads and produces clients and revenue at the other end. So that could be automating parts of the process. It could be having more of a lead funnel. Therefore, before going and seeking investment, if you're profitable, I would be using some of those profits to do some test campaigns and kind of build up a very basic funnel, whatever you feel that may be. Maybe it's a Facebook ads funnel, and test it and show that you can, when you spend a smallish amount on Facebook ads, it generates X number of leads and we can convert those. Once you've got that data in place, you can then start to, one, build out your model using that data and that test campaign, and two, you can reassure investors that you're on the path to converting from founder-led sales to kind of sales that can scale beyond kind of referrals and that kind of thing. So I would do a bit of getting some stuff in place first to kind of prove that you are starting to figure that out, and then go and raise investment to kind of figure it out properly. And you're kind of raising investment to get to a point where you've kind of somewhat along the road of proving that you can scale this up beyond referrals, and you've got a mix of channels, and 30% of sales come from referrals now, and 30 from paid ads, and another 30 from maybe organic Google search or something like that. But you're raising enough funding to kind of expand out of referrals, but you're showing a little bit of ingenuity and kind of going figuring this out for myself using what profits I have available in the business, just to do some test campaigns and kind of figure out what works, what doesn't work. And I think that will be the confidence that investors would need. What other questions do we have? Oh, Peter's asking how we reach out to angels and investors. Jump on the website, book a call. Happy to talk you through that. I'm not going to take up time now doing a sales pitch. So jump into the Robot Mascot website, contact our team, they'll book a call and we can talk through how we do that. What else have we got? Have you got any from you that you want to tackle?
Yeah, just looking at this, the anonymous attendee again, I'm not sure if it's the same one, but it's about the white label question. I suppose it's not necessarily a case of you won't be able to, so the question is, are you saying that those who white label can't find investment if the IP belongs to the white label company? Well, that's not necessarily the case, but the question then would be, where does the value lie in the company? And if it's a white label where you are reliant upon a license from a white label company and you're licensing that software or whatever it might be and then reselling, obviously that has a value, but the investor might identify that as a potential risk if that's where the value lies. But if you're generating revenue from a white label offering, then you are still investable. But not having proprietary IP might investors might look slightly differently in that situation.
It'd be the way that it would affect the type of investor that would be attracted to this, and you would need to be smart in the way that you present this, because the IP or the technology or whatever it is you're building isn't necessarily the only valuable asset in the business. There's lots of valuable assets, and one of those could be the brand. One of them could be the sales and marketing function that we just talked about. If you've got a repeatable and scalable sales and marketing funnel where for every £100 you put in, it generates 1,000 in revenue, you've pretty much got a license to print money, right? You can just grow and grow and grow and grow. So we've had a situation where a founder's, it's not quite exactly the same. They're not using a white label solution that they don't own the IP for, but they had built a technology that was okay, but it wasn't market leading. And an investor had the market leading version of that product in their portfolio, but they couldn't make sales. Our client had a hands down the best sales and marketing system. They were just generating revenue and revenue and revenue, and they had this repeatable system, and it was scalable and it was repeatable, and they were selling a all right product that wasn't best in class. So the investors proposed a merger and acquisition and said, you can solve a problem of our existing portfolio client because you can sell their product that they can't sell, and they have the best in class tech. In that situation, the company that survived is the one that built the brand and the one that had the repeatable sales and marketing function, and they swallowed up this failing technology business that had market leading tech but couldn't sell it. So the value and the value to the company, and the one that led the company that came out on top in that scenario, was the one that had the valuable asset of sales and marketing and brand, and not necessarily the valuable asset of IP. So it's not always down to the technology, but if you can have all three of those things, you're going to be much more highly valuable than if you've got two of those things and you're white labeling some IP. But it just affects the value, and it affects the type of investors that would be interested, but it's not a deal breaker.
Great. I mean, I think maybe just one more. Other questions are coming in, but I think we've run over time. But just very quickly to Colin's question in the pitch, how important is it that entrepreneur indicates they want the investors' involvement and expertise, not just their money? I mean, quick thoughts on that. Certainly in VCs, that their involvement is kind of a given in any event. They're almost certainly going to want to be able to appoint an investor director or at least an observer to your board of directors. So their involvement is kind of a given. In a broader point, I think in seeking the right VC, you want, as we talked about before, you want a good partner, someone who understands the industry, someone who can bring to bear their expertise. So I think being open to involvement is very much a good way of doing things, because ultimately you're aiming for the same goal, which is to grow the business for a successful exit. So I don't know if you've got any thoughts, James.
Yeah, absolutely that. I think you want smart money in the early years, and it's do you have that personal relationship, and can they open doors, and can you work well together, as well as can they give you capital, is a big decision. Obviously, VCs want to be involved in some capacity because they need to make sure the direction of the company is going in the direction that means that they can protect their capital and protect their investment and guide based on their experience. So the chances are people are going to want to be involved. I would always just be upfront with these investors during the conversations you have with them, and kind of say, look, I'm actively looking for investors that can bring more to the table than capital, because I know I have gaps in my knowledge around X, Y, and Z, and I'm looking for investors that ideally can help me fill those gaps, or can open doors, or do whatever it is you kind of need to get that next phase of the growth going. So I'd just be open about kind of what you're looking for. You can also ask the investors to say what they're looking for, right? You can say, look, are you looking to be a passive investor or an active investor? And if they say active investor, what does that look like to them? How do they want to be involved? Are they wanting weekly meetings, or are they wanting quarterly meetings? Are they, do they want to be a NED on the board? Do they want to just be kind of a low-key advisor that meets once a quarter for an hour? Find out what they want, because it's their commitment and their time commitment as well as their capital, and they'll have different expectations themselves. So yeah, just that's a conversation to be had with those investors. And look, if you're closing a round and you've got 4 or 5 investors on the cap table, you might not want all of them to be active investors, because suddenly you've got a huge number of people putting their opinion into your business. You might want 2 or 3 to be active and the rest to be sort of fairly silent partners and fairly passive in the situation. So you don't want to be in a position where you've got 5 investors and turns out they're all really keen to be super active, and suddenly you've got this overwhelm of ideas and direction, and you're kind of paralyzed by all of this input. So you've got to tread carefully and get the right balance, I think.
Great. Yeah, thanks for that. And I think we've overrun now. So apologies to those who put in questions and we haven't got to them. But the plan now is we're going to circulate a link with a recording of this webinar, and also with details where you can book a call with Dragon Argent, and we'll give James details as well. So if you need to get in touch with James, you can do. And we'd be happy to speak if you book calls through that method. Can I say, James, thank you so much for joining. Really enjoyed that, and I thought it was hopefully really, really useful for founders. I found it useful listening to all your thoughts on that. Massively appreciate it. Thanks for joining.
Thanks for having me. I'm thrilled that you've put this on. It's been a great event. Thank you.
Brilliant. And as I say, everyone who's joined will be receiving the recording and some extra details as well if you want to get in touch. So thanks again, and have good days, everyone.